Welcome back to The Explainer, everyone. I am absolutely thrilled to have you here today because we are doing something I love. We are putting Byline Bancorp through the ultimate investment stress test. We're going to take this regional bank and run it through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. We want to see if it actually has what it takes to earn a spot in a high-caliber portfolio. Plus, we're going to layer in some modern discounted cash flow and comparable multiples analysis just to give us the complete picture. So buckle up because we are throwing Byline Bancorp right into the Guru Gauntlet. Here is our roadmap for today. 1. Company snapshot. 2. The Buffett lens. 3. The Lynch lens. 4. The Graham lens. 5. DCF valuation. And 6. Synthesis and final verdict. Section 1. Company snapshot. Let's meet the challenger. Okay, before we get into the weeds evaluation, let's look at where the stock is right now. Based on our source data from July 15, 2026, Byline Bancorp, ticker symbol BYC, is trading at $37.48. That gives them a total market capitalization of about $1.7 billion. So we're not talking about some mega-cap Wall Street behemoth here. This is a substantial, highly focused regional player. So what is Byline's actual business? Well, they're a Chicago-based commercial bank sitting on roughly $9.9 billion in total assets. And a huge piece of their puzzle is commercial real estate, or CRE lending. And honestly, business has been booming for them. In Q1 of 2026, their net margin jumped a staggering 603% year over year, hitting 33.43%. They're crushing it so hard in their niche that their CRE group just closed over $350 million in commitments and actually won Lender of the Year at the Illinois Real Estate Awards. Section 2. The Buffett lens. Moats and management. You know how Warren Buffett operates. He wants durable economic moats, predictable earnings, and fantastic return on equity. And frankly, Byline perfectly checks off these notoriously strict criteria. Look at the moat. They have this deeply entrenched, award-winning real estate niche in the Midwest. Earnings consistency, 11 straight years of positive net margin. And if we look at return on equity, taking their Q1 net income of about $37.6 million, annualizing it to roughly $150 million, and dividing that by their $1.37 billion in total equity, we get a really solid ROE of around 11%. Add in a rock-solid 13.64% Tier 1 capital ratio, and you've got a highly durable business.
But as we all know, Buffett is incredibly disciplined on price. If we assume that $150 million in owner earnings, just using that income as a proxy here, and apply his standard 10% discount rate to bake in a margin of safety, Buffett's intrinsic value model prices this stock right around $33 per share. So what does that mean? It means he'd absolutely respect the business, but at the current $37 price tag, he'd be sitting on his hands, waiting for a better deal.
Section 3. The Lynch lens. Growth and value. Peter Lynch is famous for categorizing a stock before doing anything else. When you look at Byline's $9.9 billion in assets, their very established Chicago footprint, and a steady 12-cent quarterly dividend yielding roughly 1.28%, we can comfortably label this a stalwart. Now, stalwarts aren't going to triple in a year, right? But they do give you excellent downside protection and nice, predictable growth. But here's where it gets a little tough for a Lynch investor. He heavily relies on the PEG ratio, price to earnings divided by growth rate. Byline's estimated PE ratio is about 11.2. If we divide that by the CFO's own projection of mid-single-digit loan growth, let's call it 5%, we get a PEG ratio of 2.24. Lynch usually wants that number at 1.0 or lower, so a 2.24 suggests the market has already priced in a lot of that future growth. Now, having said that, Lynch would be thrilled with management's capital allocation. Just in Q1 of 2026, they repurchased 318,000 shares. That's returning 40% of their net income straight back to shareholders. They're keeping the balance sheet fortified, even while navigating what the CFO called inconsistent economic signals. Still, because of that elevated PG ratio, Byline lands as a classic Peter Lynch hold. Section 4. The Graham lens. The defensive investor. Benjamin Graham does not care about your story. He cares about cold, hard numbers. And when we run Byline through his incredibly strict defensive investor checklist, well, it actually survives. It's kind of amazing. Adequate size? Pass. 1.7 billion market cap. Strong finances? Pass. 14.86% total capital ratio. Earnings stability? Pass. 37.6 million Q1 net income. Dividend record? Maintained.
And with a PE of 11.2 and a price to book of just 1.24, it easily clears the moderate valuation hurdle.
Since it passes the checklist, we get to use Graham's legendary intrinsic value formula, the square root of 22.5 times earnings per share times book value per share. Let's do the math real quick. We'll annualize their Q1 EPS to get $3.32. For the book value, we take their $1.37 billion in equity and divide it by the assumed 45.3 million shares, giving us a book value per share of $30.24.
So, what happens when we plug those inputs into the formula? The result is pretty wild. The model spits out a fair value of $47.53 per share. With the stock currently sitting at $37 and change, that is a massive 21% margin of safety. To a traditional Benjamin Graham deep value investor, this is a table-pounding buy.
Section 5, DCF valuation and institutional metrics. So we've looked at the historical gurus, but we've got to bring in some modern institutional math, right? Let's build a discounted cash flow model. We'll use our annualized $150 million net income as a proxy for free cash flow. We'll project that out using the CFO's 5% growth guidance for the next 5 years. Then, we'll assume a really conservative 2% perpetual terminal growth rate. And finally, we'll discount it all back to today using a standard 10% weighted average cost of capital. A DCF is completely dependent on its inputs, which is why we always run a sensitivity table. Look at our base case scenario in the middle there. 10% discount rate, 2% terminal growth. It yields a fair value of $46.35 per share. Notice how insanely close that is to our Graham valuation. Honestly, even if we stress test this and bump the required return up to 12%, the fair value only drops to around $36.90, which is basically right where it's trading today. We also looked at some other models, dividend discount models, and comparable PE and PB multiples against their peers. And across the board, these metrics suggest Byline is currently trading right in its fair value band of about $36 to $37.50. It seems like the market is actually pricing this bank incredibly efficiently right now based on its current earnings. Section 6, Synthesis and Final Verdict. So, what does this all mean when we put the pieces together? It's a fascinating split. The strict, deep value quantitative models like Benjamin Graham and our base case DCF see tremendous intrinsic worth here. They're giving us fair values in the upper 40s and screaming buy. But on the other hand, qualitative and growth-focused investors like Buffett and Lynch, they like the company, but they are demanding a cheaper entry point because of the slower growth. They're telling us to hold or wait. Let's bring it all home. Byline's strengths are obvious: phenomenal net margin growth, an elite lending team, and plenty of capital. The big risk, which their own management team called out, is the inconsistent economic signals in the broader economy. So blending all these legendary frameworks together, our final verdict at the current price of $37.48 is a cautious hold. However, and this is absolutely crucial, if market volatility pushes this stock down into that $32 to $33 range, it triggers the criteria for almost every single guru framework which is covered, turning it into an absolute screaming buy. I want to leave you with one final thought to ponder. We are in an era of wildly unpredictable interest rates and really mixed economic data. So you have to ask yourself, is the solid, stalwart safety of a well-capitalized regional bank like Byline worth paying a premium price for today? Or does patience truly pay off for the value investor? Thank you so much for joining me for this explainer. Keep crunching those numbers and keep questioning the market.